what we actually see from the data itself is that actually for the past quarter and year to date itself, Chinese fund market has been performing really, really exemplary. So to give you an example in a relative comparison itself, compared to the rest of APAC in the first Q itself, which saw about an outflows of 40 billion. China saw an inflows of about 135 billions, excluding money market funds itself. So despite all these sort of market fluctuations, we expect to see them picking up steam due to the volatility in the market, due to many different types of news coming in. Overall, we think that China's market or sort of fund flows itself is still at a very, very good place. And a lot of this is actually driven by the governments to try to stem and try to regulate the market to prevent a repeat of the 2015 sort of overheating and stock market meltdown.
You're also talking about how ETF flows have been flooding the markets in China, especially tracking the 5G and brand name drugs in the region. Do you think that makes the market more vulnerable, and especially the tech-oriented stories, the healthcare-oriented stories, which have run ahead of themselves? Does it make them more vulnerable as well?
I think that's kind of almost like the nature of the Chinese fund market itself, that if we actually look at the equity products itself and equity funds itself, most of them are actually thematic in nature. It's just that the different teams actually resonate with investors at different points in time, and bulk of it is actually driven by government's policy. So even before the 5G communications, even before sort of the consumption trends itself, we've actually seen sort of investors flock earlier to state-owned enterprises and also things, sort of teams that are tracking renewable energies and the likes of it. So this is quite a common characteristic of the Chinese fund market.